the economy has rapidly gained strength despite the ongoing pandemic, giving rise to persistent supply and demand imbalances and bottlenecks, and to elevated inflation. We know that high inflation exacts a toll, particularly for those less able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to achieving our statutory goals of maximum employment and price stability. We will use our tools to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. The economy no longer needs or wants the very highly accommodative policies that we've had in place to deal with the pandemic and the aftermath. So that's what that's really about. We're really just going to be moving over the course of this year to a policy that is closer to normal, but it's a long road to normal from where we are. Right now we are very highly accommodative, and it is really time for us to begin to move away from those emergency pandemic settings to a more normal level. Price stability is half of our mandate. There's no basis in the law for preferring maximum employment over price stability or vice versa. They're equal. However, at different times, one of them is farther away from its goal, and that's the one we need to focus on a little bit more. Sometimes that's maximum employment, sometimes it's inflation. I'd say now it's inflation. So on inflation, why do we say transitory? We said that because we thought that these supply side bottlenecks and shortages would be alleviated much more quickly than they have been. If you look across, the global supply chains and what's happening domestically, look at our ports, look at Long Beach and LA, the two big ports on the West Coast for Asia. The number of ships at anchor is still at a record level. So we're not really seeing yet the kind of progress we essentially all forecasters really thought we'd be seeing by now, and that's really what's driving it.